Welcome to this explainer. Today, we are taking an objective, energetic, deep dive into a company that has honestly become one of the most polarizing stocks in the European tech sector right now. We're talking about SAP SE, the German enterprise software giant. Now, if you follow the market, you already know exactly what company we're dealing with here, but today we're going way beyond the headlines to figure out what is really going on under the hood.
Here's how we're going to break this all down today. We'll start by unpacking this massive market disconnect we're seeing, then we'll lay out both the bull and the bear cases. After that, we'll deliver our final verdict based on your investment time horizon and wrap it all up with some concrete takeaways. All right, let's jump straight into part one, the massive market disconnect.
Think about this for a second. Over the past 12 months, the stock corrected by roughly 25%. But if you look at the drop from its 2025 peaks, we are talking about a jaw-dropping decline of over 50%. I mean, for a company of this sheer scale and global importance, a plunge like that really forces us to ask a tough question. Are we looking at a classic value trap here, a cheap stock that's just going to keep getting cheaper? Or is this literally a generational buying opportunity? And that brings us to the core mystery. The broader market has essentially hit the panic button, pricing in a major slowdown based on fears about cloud growth decelerating and SAP's incredibly expensive bets on artificial intelligence. But here's the kicker. When you actually dig into the raw data, the underlying business is performing so much better than that plummeting stock price would have you believe. So, let's shift gears to section 2 and talk about the bull case, because this company is actually sitting on a remarkably solid foundation. Just look at the second quarter of this year. Overall, cloud revenue surged 24%, hitting 6.28 billion euros. But the real showstopper? That would be their crown jewel, the Cloud ERP suite, which grew by a massive 27%. Now, for anyone unfamiliar, ERP, or Enterprise Resource Planning, is the software that essentially acts as the central nervous system for a company's day-to-day operations. For a giant like SAP, pulling off 27% growth isn't just decent, it is absolutely best in class. It tells us that their core transition to the cloud is going phenomenally well. On top of that, the visibility for investors right now is just exceptional. We all know that in investing, predictability is king, right? Well, SAP's current cloud backlog is up 26% to a massive 22.9 billion euros. That metric represents contracted, guaranteed future money that we know for a fact is coming in over the next 12 months. Having a 22.9 billion euro cushion, that provides tremendous insulation against any broader economic headwinds. Now, you might be wondering, how is that 22.9 billion euro backlog so secure? It all comes down to their moat. SAP systems manage the entire financial spine and the incredibly complex supply chains of the world's largest companies. Because of that, switching away from SAP to a competitor is practically impossible. It would take these massive corporations literally years of operational disruption and cost them billions of dollars to do it. Honestly, anyone who has ever survived a corporate software migration knows the sheer soul-crushing pain involved, and that is exactly why clients rarely leave. So even as the macroeconomy softens, these huge clients simply cannot cancel their contracts. They are locked in for the long haul. Because the stock has taken such a beating, we're currently seeing a major valuation reset. The forward price-to-earnings ratio, which is basically how much you're paying today for the company's future profits, has dropped to roughly 19.8 times. That is 41% below its 18-month average. We are talking about a steep discount to historical averages here. Major firms like Morningstar currently have a high-end fair value estimate on the stock at 265 euros. But even if we take a more conservative approach, the average analyst price target is sitting around 210 euros. That employs a potential upside of over 50% from where it's trading right now. Add to all of this an immediate catalyst. Management is actively returning capital to shareholders. They've already executed a significant share buyback, repurchasing nearly 2.6 billion euros worth of shares this year. That puts a really strong floor in place to support earnings per share while we wait for the broader business to accelerate. But to be completely objective, we have to look at the other side of the coin. So let's move into section 3, the bear case and the near-term storm that is keeping so many institutional investors sidelined. The bear case basically boils down to 4 big interrelated problems. The first, and honestly the biggest issue right now, is the AI profit squeeze. Management knows AI is the future, but building that future is incredibly costly today.
They've made recent acquisitions, specifically Dremio and Prior Labs, that are highly dilutive. We're talking over 100 million euros in annual profit just gone. Because of this, SAP had to trim its 2026 operating profit outlook down to roughly 11.8 to 12.2 billion euros. And let me tell you, if there is one thing the market absolutely hates, it's near-term margin pressure. Problem number 2 is decelerating growth. Management has guided that full year 2026 revenue will only be in line with the prior year, so effectively flat. On top of that, SAP CFO Dominic Assam was very clear that we won't see a reacceleration in growth until 2027. With global interest rates sitting where they are, waiting until late 2027 for a growth story to resume, that is just too long of a wait for a lot of investors. Problem number 3 is the fierce competition. Listen, SAP isn't operating in a vacuum. They are fighting a brutal two-front war. On one side, you have Oracle aggressively pivoting to the cloud and eating into SAP's market share in specific verticals. On the other side, you have the hyperscalers. We're talking Microsoft, Google, and AWS. Because those giants own the underlying cloud infrastructure, they're offering their own AI tools that plug right into SAP's data. If SAP doesn't successfully monetize its own data quickly, the massive risk here is that they just become a commodity data layer rather than the highly profitable platform owner they want to be. And finally, problem 4 is simply the current market sentiment, which is heavily bogged down by all this short-term pessimism. The stock currently holds a Zacks rank of number 4, which is a sell, and prominent firms like JP Morgan have slapped a neutral rating on it with a pretty modest price target of 175 euros. What that tells us is that right now, there is basically zero urgency in the broader market to buy this stock. Okay, so how do we reconcile all of this? Let's move to section 4, our verdict on how to resolve this market disconnect. Here is the absolute most fascinating part of this whole story. Both the bulls and the bears, they're actually both right. It just completely depends on your time horizon. If your window is short-term, say 12 months, this is a volatile hold or maybe even a neutral to negative play. You can expect a lot of sideways movement as the company absorbs those heavy AI integration costs and the reality of that lower guidance sets in. But if your horizon is long-term, like 3 to 5 years, this becomes an incredibly compelling buy. The current price already has all that bad news baked right into it. What the market is completely missing is the upside optionality. Once those AI integration costs stabilize by mid-2027, SAP is going to move toward usage-based pricing. When they apply AI to those complex financial and supply chain processes, they are going to lock their clients in even deeper and at much higher price points. And right now, you are getting this monopoly at a 40% discount to its historical valuation. Which brings us to our 5th and final section, the actual investment takeaways and how to execute on this thesis. If you're thinking about jumping in, keep these 3 things in mind. First, trust those fundamentals. That 26% backlog growth is the best leading indicator we have that the core business is absolutely thriving. Second, the valuation is undeniably attractive. This heavy sell-off has created a very real margin of safety for new buyers. Third, execute cautiously. There is no need to rush in all at once. Investors should look to initiate or scale positions gradually, averaging in over the next 6 months or so as the market fully digests that lowered guidance and works through the near-term volatility. At the end of the day, what we are looking at is a classic case of pain before gain. It is completely understandable why investors might feel frustrated by this current dip, but SAP is doing exactly what tech leaders have to do to survive. They are pouring immense amounts of money into their future. And right now, they're just getting severely punished for it by a highly reactive market. So I'll leave you with this final thought to consider for your own portfolio. Does your investment time horizon allow you to stomach this painful near-term volatility in order to capture what could essentially be a generational buying opportunity heavily skewed to the upside? Thank you so much for joining me on this explainer, and I hope this deep dive helps you navigate the true value hiding just beneath the surface of SAP.